In 1929, while millions of investors lost their life savings in the Great Crash, one man made $100 million by following a simple principle that 99% of traders still ignore today. What if I told you that same principle just flashed a major warning signal in today's market? Today, we're diving deep into Jesse Livermore's legendary teachings on reading market character and spotting danger signals before the crowd realizes what's happening. Livermore, known as the Great Bear of Wall Street, turned $5 into $100 million by mastering one skill that most traders never develop: understanding that stocks, like people, have predictable personalities. You're about to discover why your biggest enemy in the market isn't other traders, algorithms, or even market makers. It's something much closer to home, and I'll show you exactly how. Livermore's normal reaction principle could save you from the next market crash while positioning you for massive gains when others are paralyzed by fear. Let me paint you a picture of today's market reality. We're living in an era where retail traders make more transactions in a single day than investors made in an entire year during Livermore's time. The average holding period for stocks has dropped from 8 years in the 1960s to just 5.5 months today. And here's the kicker. With all our advanced technology, real-time data, and sophisticated algorithms, the average retail trader still loses money. Why? Because we've become addicted to the noise. We're glued to our screens, checking prices every 5 minutes, reacting to every tweet, every headline, every tiny fluctuation. But here's what Jesse Livermore understood that most modern traders don't. The big money isn't made in the daily fluctuations. It's made by positioning yourself for the major moves and having the discipline to stay put. Think about this. Livermore made his fortune with telegraph technology and paper records. He didn't have CNBC, Twitter, or real-time quotes on his phone. Yet he consistently outperformed the market by understanding something fundamental about market psychology that remains true whether you're trading in 1929 or 2024. Markets move in predictable patterns, and those patterns reveal themselves to anyone patient enough to watch and disciplined enough to wait. The character of stocks understanding market personality, as Jesse Livermore taught us, stocks, like individuals, have character and personality. Some are high-strung, nervous, and jumpy. Others are forthright, direct, logical. This isn't just poetic language. It's a profound insight into market behavior that could transform your trading. Have you ever noticed how Apple stock tends to grind higher steadily, while Tesla can swing 10% in a day? Or how certain bank stocks barely move for months, then suddenly explode higher? That's not random. That's character. According to Livermore's principle, once you understand a stock's personality, their action is predictable under varying sets of conditions. Think about that for a second. If you could predict how a stock would behave under different market conditions, wouldn't that give you an incredible edge? Let me give you a modern example. During the 2020 pandemic crash, tech stocks with strong character, companies like Amazon, Microsoft, and Zoom, quickly recovered and surged to new highs. Meanwhile, stocks with weaker character, many retail and travel companies, stayed depressed for months or even years. The traders who understood this character difference made fortunes. Those who didn't got crushed trying to catch falling knives. The automated movement principle. Here's where Livermore's genius really shines through. He observed that when a stock gets into a definite trend, it works automatically and consistently along certain lines throughout the progress of its move. Have you ever wondered why some stocks seem to go up day after day, almost mechanically, while others chop around endlessly? It's because, as Livermore discovered, true trends have a life of their own. They don't need constant news or catalyst. They feed on their own momentum. This is exactly what we saw with Nvidia in 2023. Once the AI trend took hold, the stock moved automatically and consistently higher, following Livermore's pattern perfectly. Every small dip was bought, every pause was brief, and the trend continued until the danger signals appeared. But we'll get to those in a moment. Principle decoding market movements is where Jesse Livermore's teachings become pure gold for modern traders. He identified what he called the normal reaction, a predictable pattern that occurs in every genuine market move. According to Livermore, at the beginning of the move, you will notice a very large volume of sales with gradually advancing prices for a few days. Then, what I term a normal reaction will occur. Let me break this down with real numbers, using Livermore's own example, but applying it to today's market. Imagine you're watching a stock that starts at $50. Here's how the pattern unfolds. First leg, the stock moves from $50 to $54 on heavy volume. This is your initial signal. Big money is accumulating. But here's where 90% of traders mess up. They see the move, they FOMO in at $54, and then, first, normal reaction. The stock pulls back to $52. Panic sets in. Did I buy the top? Well, they wonder. Half of them sell at a loss. But Livermore tells us, never be afraid of the normal movement. Why shouldn't you be afraid? Because, as Livermore's principle shows us, on that Reaction in the sales volume will be much less than on the previous days of its advance. Low. Volume on the pullback means the big money isn't selling. They're letting weak hands exit. Second leg, the stock recovers and pushes to $59, $60. Notice something important here. It moves 6 points versus 4 points in the first leg. The moves are getting bigger. Why? Because as Livermore observed, the stock is becoming harder to buy. Have you ever tried to buy a stock in a strong uptrend and found your orders weren't getting filled? Or noticed how the price seems to gap up every morning? That's exactly what Livermore is describing. The supply is drying up because smart money is holding, not selling. Second normal reaction. Now the stock pulls back 3 points to $57. Notice it's a bigger point decline than the first reaction, but percentage-wise, it's actually similar. This is still normal, still healthy. Third leg. This is where things get exciting. Following Livermore's approach, the stock could run from $60 to $68, $70 without encountering a natural reaction. The moves are getting more violent, more emotional. FOMO is at its peak. The time element's secret, but here's the $1 million insight from Livermore that almost nobody talks about. And that is where the time element comes in. As Jesse Livermore famously said, don't let the stock go stale on you. After attaining a goodly profit, you must have patience, but don't let patience create a frame of mind that ignores the danger signals. What does going stale mean? Have you ever held a stock that stopped making new highs but didn't really decline either? It just sat there? That's staleness, and it's often the calm before the storm. Think about Bitcoin at $69,000 in late 2021. It stopped making new highs, started chopping sideways, but holders kept saying diamond hands and HODL. Well, they ignored the staleness. Those who understood Livermore's principle got out near the top. Those who didn't rode it all the way down to $15,000. The danger signal system. Recognizing abnormal reactions. This is it, the part that could literally save you tens of thousands of dollars. Jesse Livermore's danger signal system is elegantly simple, yet most traders completely miss it. According to Livermore's teachings, all during the progress of the move, it had nothing but natural and normal reactions. Then all of a sudden, an abnormal reaction occurs. And by abnormal, I mean a reaction in one day of 6 or more points from an extreme price made in that same day. Let me paint this. Picture for you using a recent example that followed Livermore's pattern exactly, the regional banking crisis of 2023, Silicon Valley Bank, SVB, had been in a steady uptrend for months. Normal reactions, steady progress. Then, on March 8th, 2023, the stock opened at $267, spiked to $272 in the morning, then crashed to $218 by the close. That's a $54 intraday reversal. A massive abnormal reaction. What did most traders do? They bought the dip. It's oversold, they said. Banking is solid, they rationalized. The next day, it opened at $106 the day after. The bank was shut down. But here's the thing. Livermore warned us about this exact scenario nearly 100 years ago. He said when you see that abnormal break, that is an immediate danger signal, something it has not had before, and when something happens abnormally stock market-wise, it is flashing you a danger signal which must not be ignored. The railroad track wisdom. This brings us to one of the most powerful metaphors in all of trading literature. As Livermore's colleague told him, when I see a danger signal handed to me, I don't argue with it. I get out. A few days later, if everything looks all right, I can always get back in again. If I were walking along a railroad track and saw an express train coming at me 60 miles an hour, I would not be damned fool enough not to get off the track and let the train go by. Can you imagine standing on railroad tracks, seeing a train barreling toward you and thinking, maybe it'll stop, or maybe it's not as close as it looks? Sounds insane, right? Yet that's exactly what we do in the markets every single day. How many times have you seen a danger signal? Maybe a break of support, a reversal pattern, an abnormal reaction, and instead of getting out, you rationalized staying in? It's just a shakeout. The fundamentals are still good. I'll wait for a bounce to sell. Following Jesse Livermore's principle, when you see that danger signal, you don't negotiate with it. You don't analyze it, you don't hope it away. You get out, you can always get back in if you're wrong, but if you're right, you've just saved yourself from potential disaster. The psychology of hesitation. Here's where Livermore's genius understanding of human psychology really shines. He observed, the trouble with most speculators is that something inside of them keeps them from mustering enough courage to close out their commitment when they should. Why does this happen? Why do smart, rational people ignore clear danger? Signals? Livermore identified the pattern. They hesitate, and during that period of hesitation, they watch the market go many points against them. Then they say, on the next rally, I'll get out. Does this sound familiar? Have you ever told yourself you'd sell on the next bounce, only to hold through multiple bounces because each one made you think the worst was over? As Livermore taught us, when the next rally comes, as it will eventually, they forget what they intended to do, because in their opinion, the market is acting fine again. This is exactly what happened to most Peloton investors in 2021. The stock peaked at $171, showed clear danger signals with abnormal reactions, but investors kept waiting for one more rally to get out. They rode it all the way down to $8. Your greatest trading enemy. Jesse Livermore drops a truth bomb that most trading educators won't tell you. The human side of every person is the greatest enemy of the average investor or speculator. Think about that. It's not the market makers. It's not the algorithms. It's not the hedge funds. Your greatest enemy is you. According to Livermore's principles, wishful thinking is the cancer of trading. Why shouldn't a stock rally after it starts down from a big advance? Of course, it will rally from some level, but why hope it is going to rally at just the time you want it to rally? Have you ever found yourself staring at a losing position, literally willing it to go up? Checking the price every 5 minutes, hoping this time it'll be green? That's wishful thinking, and it's account suicide. The overtrading epidemic. Here's a statistic that would make Livermore spin in his grave. The average Robinhood user makes 40 trades per month. 40! Livermore made his fortune by making maybe 4 or 5 significant trades per year. As Jesse Livermore emphatically stated, one cannot be successful by speculating every day or every week, that there are only a few times a year, possibly 4 or 5, when you should allow yourself to make any commitment at all. But why do we overtrade? Livermore understood this too. Speculation is far too exciting. Most people who speculate hound the brokerage offices or receive frequent telephone calls, and after the business day, they talk markets with friends at all gatherings. Replace brokerage offices with Reddit forums and telephone calls with push notifications, and you've described the modern trader perfectly. We're addicted to the action, and that addiction is costing us fortunes. The Mountain Man's Secret. This might be my favorite story from Livermore's teachings. He tells of a remarkably successful speculator who lived in the California mountains and received quotations 3 days old. 3 days! Today we panic if our quotes are 3 seconds delayed. This mountain trader would come down 2 or 3 times a year, place massive orders, and consistently make money. When asked his secret, he said, "I would be a failure if I were in the confusion of things and let myself be distracted by minor changes. I like to be away where I can think. Can you imagine the discipline that takes?" While everyone else was frantically trading every wiggle, this man was sitting in the mountains, looking at 3-day-old prices and crushing the market. His philosophy, which perfectly aligns with Livermore's teachings, real movements do not end the day they start. It takes time to complete the end of a genuine movement. Think about the biggest market moves of the last few years. The COVID crash took weeks to unfold. The 2022 bear market lasted the entire year. The AI rally has been going for over a year. You didn't need minute-by-minute quotes to profit from any of these moves. You needed patience and discipline. Building your trading system. Following Jesse Livermore's approach, here's exactly how to implement these principles in today's market. Step 1. Identify character. Start keeping a journal of how your stocks behave. As Livermore shows us, you need to know and respect individual securities. Track. How does the stock react to good news versus bad news? What's its average daily range? Does it gap frequently or trade smoothly? What volume patterns precede its moves? Step 2. Wait for the setup. According to Livermore's principles, you're looking for that initial surge on heavy volume. In today's terms, volume, at least 2x the 20-day average price break above a clear resistance level, multiple days of accumulation, big money buying. Step 3. Buy the first normal reaction. This aligns with Livermore's observation that the first pullback is usually the safest entry. Look for a 3 to 5% pullback from the initial surge volume dropping to below average on the pullback price, holding above the breakout level. Step 4. Monitor for danger signals. As Jesse Livermore taught us, watch for abnormal intraday reversals, 6% plus from high to close, failure to make new highs after pullback volume surging on down days, the stock going stale, sideways action after a big move. Step 5. Honor your stops, following Livermore's railroad. Track principle. When you see danger, get out. Set your stops below the last normal reaction low at a level where the character changes, where an abnormal reaction would occur. The modern mountain man approach want to really follow Livermore's principles? Here's a radical suggestion that could transform your trading. Weekly review system. Check your positions once per week. Sundays work well. Look at weekly charts, not daily. Make all trading decisions based on weekly closes. Delete all trading apps. From your phone during the week, this mirrors the mountain man's approach, but adapted for modern markets. You're removing yourself from the confusion of things while still staying informed. The 4-trade rule, as Livermore famously advocated, limit yourself to 4 to 5 significant trades per year. That means each trade should be thoroughly researched. Each position should be meaningful, no 1% positions. Each trade should follow a major market signal. You're out of the market more than you're in it. Have you ever noticed that your best trades are usually your highest conviction ideas? The ones you've researched for weeks, waited patiently for the setup, and sized appropriately? That's not coincidence. That's the Livermore way. Risk management, the Livermore way. According to Livermore's principles, proper risk management isn't about stop losses alone. It's about position sizing and timing. The pyramid approach. Start with a pilot position, 25% of intended size. As Jesse Livermore taught us, if you have timed the movement correctly, your first commitment will show you a profit at the start. Only add to winning positions. Add 25% on the first normal reaction. Add 25% on the break to new highs. Keep 25% in reserve for the final leg. The time stop? If a stock doesn't move in your favor within a reasonable time, Livermore suggested a few. Days to a week. Something's wrong. This prevents dead money and opportunity cost. Creating your edge. As Livermore discovered through years of study, by constant effort I was able to bring my records into a coordination that aided me to a surprising degree in anticipating coming movements. Here's your homework. Start building your own market database. Track 10-20 stocks. You know well, record their weekly closes, volume, and any significant news note. All normal and abnormal reactions. Look for patterns before major moves. Test your observations with small positions. The cryptocurrency market is perhaps the purest expression of Livermore's principles in modern finance. Why? Because crypto trades 24/7, has no circuit breakers, and is driven purely by psychology and liquidity. Let's apply Livermore's danger signal system to Bitcoin's 2021 top. November 10th, 2021, Bitcoin hit $69,000 all-time high. First warning, fails to break $70,000 despite multiple attempts. Abnormal reaction. November 18th, drops from $60,000 to $55,000 in hours. The Livermore signal, intraday reversal of over 8%. Those who followed Jesse Livermore's principle and exited on that abnormals. Reactions saved themselves from a 78% decline. Those who held, they're still hoping for that next rally to get out. Remember, hesitation can be your biggest enemy in trading. In the next video, we'll uncover even more of Livermore's secrets. You don't want to miss.